Hi guys, thanks for joining me to talk about how our portfolios might be changing this quarter. In light of everything that's going on, James, could you start by talking about how our bond components are changing?
I think in terms of big picture, how we see things, our general outlook has not materially changed. That goes for both bonds and equities. But we will make adjustments where we see appropriate, and this quarterly rebalance is just that. Some minor adjustments around the fringes of our broad asset allocations. In terms of fixed interest bond markets, so we maintain a large proportion of those assets in government bonds versus corporate bonds. We're being well compensated across both those markets through the level of income received for holding those securities. In terms of our corporate bond exposure, we're running with an underweight position versus our broad peer group on the basis that we don't see ourselves being fully compensated for the additional risk to take on that credit exposure versus government bonds. In terms of changes, though, we're making a small adjustment, reducing our money market exposure, and that's in favour of increasing exposure to existing shorter dated UK government bond exposure. I say short dated, so that's a short time to maturity of the underlying securities that are held, and we're really homing in on that shorter end of the maturity scale. We think there's somewhat of a dislocation between market expectations for Bank of England interest rate hikes and what we think the Bank of England may end up doing themselves, more likely keeping rates on hold, or if they do increase interest rates, it's going to be marginal rather than the 3 or 4 interest rate hikes that are currently being priced in bond markets. So it's really taking advantage of that dislocation in the bond market currently, increasing that weighting slightly.
Okay, yeah, that makes sense. Could you cover changes we're making to the equities as well, please?
Yeah, so a bit more going on in equities, but again, overall, our outlook hasn't changed significantly. Within the equities component of portfolios, if we look at interest rate expectations, given the changes in the near term, in terms of how slow we think interest rate cuts are likely to be going forward, we're just a little less convinced of the ability for real estate exposure to outperform broad markets moving forward. So for that reason, we're exiting our real estate exposure within portfolios, with those proceeds going into a broad commodities-based allocation. This new allocation really helps us cover off longer-term inflation risks across portfolios.
And just a note there, James, for our responsible future investors, they can't invest in a commodities basket due to the fossil fuel content. How are we achieving that same inflation protection for them?
You're right, Ollie. So in terms of our responsible future portfolios, we run a series of exclusions, and one of those being fossil fuels. So in terms of the commodities exposure, that's incorporated within the standard portfolios. When it comes to responsible future, the premise of that commodities trade is for that longer term inflation hedge, inflation protection for us. Another route for us to take is infrastructure exposure. Real infrastructure assets, their earnings, their revenue streams, they're largely tied to inflation. So that's a way for us to incorporate that inflation protection that we're looking for, whilst also adhering to the rules for our responsible future portfolio range.
Okay, so a different asset, but achieving the same aim.
Exactly.
Okay, and how are we changing our exposure to financials?
In terms of that financials exposure, it's been a key component to our portfolios for some time. We don't expect quite the same pace of rate cuts going forward, and financials really benefit from a widening gap between short-term borrowing and long-term borrowing. The proceeds from that trade are going into broad-based US equities without overly exposing portfolios to the riskiest areas of US equity markets, most notably the technology sector.
On the subject of technology, are we changing our technology-specific exposures also?
We are. So overall technology exposure is going largely unchanged, but how we approach technology exposure, we're making adjustments there. So for some time, we've had quite a large exposure to the artificial intelligence hyperscalers. You may have heard them referred to, the Mag 7 in the US equity market. So we're quite happy to maintain exposure to those businesses, but we're just looking to readjust our exposure to the broad sector. So incorporate more businesses that you'd consider the enablers of artificial intelligence, or the beneficiaries. Beneficiaries being businesses that are incorporating AI into their processes, their services, their business models. Enablers are those businesses that are key to enabling AI developments going forward. Data centers, for example, the fiber optics that go into data centers, these types of businesses that produce those, produce that hardware are key to progress.
And lastly, how about our infrastructure holding?
Well, infrastructure has been a key component of portfolios since launch. It's performed very well for us. It's held up well during the recent volatility that we've seen amid the geopolitical tensions with Iran. It's part of the defensive element of portfolios. It gives us that utilities exposure. And all we're looking to achieve as part of this trade is to really enhance that exposure that we have to real assets, to that inflation protection and good, consistent, long-term revenue streams from those businesses to shore portfolio valuation should we see continued bouts of volatility throughout the year.
Thanks, Steve. Thanks, James. And thank you to our investors for your continued support.